All right, today we're going to dive into Salesforce's latest earnings report. And let me tell you, it's a classic case of good news is bad news. The company put up some fantastic numbers for its second quarter, and yet Wall Street just smashed the sell button. So we're going to unpack exactly why that happened and what it could mean for the future.
And this slide, well, it lays out the puzzle perfectly. On one side, you've got everything you want to see. A beat on revenue, a beat on earnings per share, and expanding margins. Just beautiful. And on the other side, the stock gets hammered, dropping over 4%. So what on earth did Wall Street see that maybe the rest of us missed? Let's start with the good stuff, because on paper, it looked really good.
Okay, first up, the top line. Salesforce pulled in a cool $10.24 billion in revenue. Now, it's easy to get numb to these giant numbers, but this wasn't just big. It was a solid beat over what analysts were expecting. And more importantly, it's 10% growth over last year. I mean, for a company this size still cranking out double-digit growth, that's a really strong signal.
Okay, so what about the bottom line? Even better. The company delivered $2.91 in earnings per share, absolutely crushing estimates. This is the number a lot of investors really zero in on, because it shows Salesforce isn't just growing for growth's sake. They're actually making real hard profit. Another huge checkmark in the win column.
Now this number, 10, this might just be the most impressive one of the bunch. This was the 10th straight quarter that Salesforce has expanded its operating margin. Think about that. In this economy, showing that kind of consistent, disciplined execution is incredibly tough, and it's the kind of thing investors usually love to see. So you've got growth, profits, discipline, a textbook A+ report card. But they didn't get rewarded. In fact, it was the exact opposite. In after-hours trading, the stock took a 4.1% nosedive. Instead, all that good news was met with a tidal wave of selling. And this is the disconnect, right? Everything in the rearview mirror for the last 90 days looked great. So the problem? It must be what they see through the windshield.
So, what gives? Why all the skepticism? To figure this out, we have to stop looking at the quarter that just happened and start listening to what the company said about the road ahead. See, the real story here isn't in the results. It's all about the guidance.
And here it is, the elephant in the room. The guidance for next quarter, Q3, signals a slowdown. That strong 10% revenue growth is now expected to drop to somewhere between 8 and 9%. Now, for a market that's been pricing in acceleration, expecting AI to hit the gas, this just felt, well, kind of weak. A huge red flag for investors.
So if you dig a little deeper, you can see three big worries bubbling up. First, investors are getting antsy. They want to see all this AI hype turn into actual revenue, and it's not happening fast enough for them. Second, this shift to a pay-as-you-go model for AI makes the numbers harder to predict. And finally, some of their other businesses like marketing and commerce showed a bit of weakness, which kind of soured the mood.
And this chart, wow, this really puts everything into perspective, doesn't it? So far this year, Salesforce is deep in the red, down 23%, while the broader software sector is up almost 30%. This tells you the market's doubt didn't just pop up overnight. It's been building for a while now. This earnings report just kind of confirmed their fears.
Okay, so Wall Street is totally fixated on the next 90 days, right? But Salesforce management, they're trying to get everyone to look further down the road. Their big answer to all this short-term worry is a massive, company-defining bet on something they're calling the Agentic enterprise. Let's break down what that actually is.
So what in the world is this Agentic enterprise they keep talking about? Basically, picture this. AI agents aren't just tools anymore. They're like digital co-workers. They're working right alongside people, handling the boring stuff, finding key insights, and totally changing how companies get work done. And the fuel for all of it? A company's own, private, trusted data.
And you better believe CEO Mark Benioff is all in on this. He's not pitching this as just some small update. To him, this is a complete transformation, a total reinvention of how businesses use software. He's really betting the future of the entire company on leading this charge. It's a huge long-term vision.
And look, this isn't just a bunch of fancy talk on a slide. There are real signs it's starting to work. Their Data Cloud and AI division grew by a mind-boggling 120% year over year. That's just explosive. It's now over $1 billion business. But here's the catch. Even a business growing that fast is still just a drop in the bucket for a giant like Salesforce. It's not big enough yet to move the needle for the whole company.
Right, so management kept hammering this point home. You can't have great AI without great data. It's just garbage in, garbage out. So their strategy is to build this AI foundation. It starts with their data cloud to get all the data in one place. Then they use MuleSoft to connect all the different systems. And that huge pending acquisition of Informatica, that's the final piece of the puzzle, making sure all that data is clean and governed.
Of course, you know the Wall Street analysts on the call weren't just going to let this vision go unchallenged. They started poking and prodding, trying to connect this big, grand vision back to the numbers for next quarter. And their questions, well, they really got to the heart of the whole debate.
Yeah, the Q&A really boiled down to three big questions. First up, hey, where's the AI money? And management's answer was basically, hold your horses, this is a long-term game, we're focused on getting people to use it first. Then, is your old business dead? They said, no way, AI makes it even better. And finally, are you buying companies or buying back stock? Their answer, why not both? They're balancing big acquisitions with massive buybacks.
All right, so let's pull all this together. We've got strong results from the past, a pretty cautious outlook for the immediate future, and this huge, ambitious vision for the long term. So what's the bottom line for the stock? It's time for the next call, our take on where Salesforce is headed.
So that really leaves us with the billion-dollar question, doesn't it? How do you balance this solid, profitable company right now against all the uncertainty about its future growth? What's the right call on the stock today?
Okay, here it is. Our rating on Salesforce is market perform. Now, what that means in plain English is we don't expect it to be a massive winner or a massive loser anytime soon. We think it's probably going to perform right in line with the broader market.
So what's the thinking behind that? Well, the company is an absolute machine when it comes to making profits, and that provides a really solid floor under the stock. But the growth story is the big question mark. That Agentic enterprise vision sounds great, but for now it's more of a story than a number on the income statement. The stock is stuck in a prove-it-to-me mode, and it'll probably just trade sideways until investors see clear proof that AI is kicking revenue growth back into high gear.
So if you're watching this stock, what are the key things to keep on your radar? The big one is their Dreamforce conference in October. That's where they'll show off their new AI toys. The number to watch next quarter is called CRPO growth. It's a hint about future revenue. The biggest risk? You guessed it, another weak forecast. And the biggest potential surprise to the upside? Clear signs that customers are finally starting to pay up for these new AI features.
So it all comes down to this. The battle for Salesforce stock is going to be fought between patient investors who believe in that long-term agentic vision and impatient investors who just want to see the growth numbers get better right now. Who wins that fight is going to be the story to watch. And as always, a quick reminder, this analysis is for informational purposes only. This is not financial advice.